In this video, traders, we look at buying put options at different strike prices, the decision we have to make as traders as to which strike to select. Hey traders, warm welcome to you. So you want to buy a put option, right? Reminder is a put option is a bearish thesis on the stock or commodity, whatever it is you're buying. You think that thing's going to go down. You want to buy a put option. You've decided on your expiry time, your time frame. Again, that's a separate decision to make, and we'll go into that in some other video. But for this video, we'll look at how you decide which strike price to choose, right? So let's look at some examples. You've got XYZ stocks currently trading at $50 and you're bearish on this thing. You think this is going lower and you think, I want to buy a put option. Just a reminder, a put option is the right but not the obligation to sell short, or just sell that stock and you can go short that stock at the strike price at the specified time in future. So if you are selling a put option at $50 and that thing goes down to $10, you will exercise that right because there's $40 worth of profit in that option. Now, the other good thing about the put options, guys, is this, is that the price could go to 1,000 and back. And if it went to 1,000, you are not losing more than you have paid for the option. If between your time you took the trade and expiry, that thing goes to 1,000, you're still only on the hook for the price you pay for those options. Whereas if you went naked short, you'd be losing every single dollar that thing goes up. So that's the advantage of a put option if you have a bear thesis. But anyway, let's go back to the point. Let's have a look at how we could decide really what strike we're going to do. So let's look at the three rough examples and you'll see how we can extend these out in a bit and see what's going on. So $50 is the price at the moment, and here's our time on our x-axis here. So our 48.50 put is priced at $1. Our 50 put is priced at $2. Our 51 put is priced at $3. Let's have a look at those. So the options price generally made up of intrinsic and extrinsic value. Intrinsic value is the profit in the deal right away. So the only one of these examples here that has some intrinsic value is this $51 put, because this has $1 worth of intrinsic value already, right? Because if this expired now at $50, we've got a right to sell shares at $51. It's got $1 worth of intrinsic value. Okay, great. So $1 worth of intrinsic, $2 worth of extrinsic. We'll look at that in a second. $50 put, right at the money. That one's already in the money. That's at the money. That's out of the money. So at the money, $50 put, $2. No intrinsic value to that because it's worthless really in terms of if it expired now, the right to sell something at 50, which is currently 50, is worth naff all. So all that is pure extrinsic value. And then we look at the 48.50 put, of course, there's no value in that because it's below the strike price, it's out of the money. And that has an intrinsic value of 0, but an extrinsic value of $1. Let's have a look closely at this extrinsic value then. So extrinsic value is really made up of the time we've got for the actual thing to happen, time to expiry, the strike price, and the implied volatility. So the further away the time, the more potentially likely this is going to happen, the more expensive it's going to be. The narrower, the closer the strike price, again, the more expensive it's going to be because it's quite likely to hit that level. And the implied volatility is how volatile this thing's expected to be. So I'm not going to dig into massively that, but that's really how the extrinsic value is calculated. But the point of this video is, how do we decide on which one to buy? And let's look at some other extreme example as well. So let's imagine now, if we look at this one and we go down to here, and let's imagine that the $30 put, okay, is currently trading at, didn't need that there, did I? Currently trading at, 10 cents, for example, right? Really kind of unlikely, $30, it's only 10 cents. So we have to make a decision now as traders, and this, how we make this decision is going to affect our profit and loss massively. We could lose, but be almost right. We've got to be pretty right with this. So we've got the decision to make. Do we buy a put that's already in the money, has some value to it? It's the most expensive, but it's the most likely of those to make us a profit. Okay, percentage wise, we might not make that much profit, but we could probably make a profit on this if the price just even goes down a little bit. We're going to make money. If it goes down to 47, we're break even. That's our break even point, isn't it? Because we've paid, sorry, if the price goes down to 48, well, that's our break even point, isn't it? Because we've got $3 worth of value in that, and it's $3. So break even is at 48, but anything below that is pure money. Okay, now $50 put, we've paid $2 for that. It's got to be 48 as well. And the 48.50 put, we've got to be at 47.50 for us to make any money. However, imagine now this stock price went down to $40 in value. So there's $10 move in the stock. What happens to each of these? Now the $50 put suddenly becomes worth $10. We've made $8 on that deal. That's pretty good, right? The 51 put becomes worth $11, and we've made a reasonable amount on that deal as well, $8 on that deal, but percentage wise not quite as much because we paid $3 for it. The 48.50 put, however, becomes worth $8.50. Right, because it's 48.50, the right to sell stock at 48.50, it's at $40, $8.50. We only paid $1 for that, so we get $7.50 profit. That's not bad for our $1 investment. That's the biggest bang for the buck, right? That's the biggest return on our investment. But of course, we've got to have it go much lower than the others. The break-even point is much lower than the other ones. So now let's look at some extreme examples. Let's say we went down to $10, right? We go down to $10. We could do all the maths for that, but we don't need to. But what I'm interested in is this one. This $30 put, if that price goes down to $10, we've only got $20 worth of value in that option. And we only paid 10 cents for that thing. $19.90 worth of profit per option. So that is percentage return is huge on what we paid for it. Yes, all these are going to be similarly valued, 48 to 50, 51 to 50. All these are similar when we go down to 10, right? You're talking a couple of bucks difference here and there. But the percentage return is where the big difference is, from 10 cents to, massive dollar amount. And so obviously the chance of it going down to $10 is slim. That's why it's priced at 10 cents, right? It's such a far away strike. It's got a long time to expiry. The implied volatility is what it is. That's built into all of these. But because we've changed the strike price so low, the likelihood becomes so low as well. That's why it's 10 cents. So the point is, if you're very bearish, then you might consider something like that, or somewhere between these two, right? Somewhere between these two. I've got an extreme here. Somewhere between these two, and you might go, you know what? Maybe halving over the year isn't such a big thing, and it's not that badly priced because the implied volatility is so low. I perhaps perceive that there's going to be a spike in volatility if we start to fall off, all that kind of stuff. So it's for you to weigh up another commercial decision for you to make in your trading business. Do I want to pay a small amount and have a less likelihood of it happening but a bigger payoff? Or do I want to pay a higher amount, have a more likely of occurrence but the payoff's not that big? You can kind of use the analogy of being a casino, right? You can go red or black. It's a 50-50 shot. Well, it's not a 50-50 shot. You get a payout, you put 10 on, you get 20 out, but there's a slight house edge there. So the likelihood of you winning is quite high, relatively speaking, over a period of time. But if you go for one of the numbers, I can't remember numbers on a roulette wheel, but I think it's 36. Someone can correct me if I'm wrong. Don't do casinos, but if you do that and you get a big payoff, right? You get a 36 times, assume it's 1 in 36, 36 times your money, great. But the chances of that happening are slim as well. So as a trader, the beauty of this is if you believe the chances of it happening are greater than the price, then there's your trading edge. You can go in and say, hey, I think it's going to happen more likely than the price. I'm going to have a go at that. And if you're right, more than you're not, over a period of time, you're going to make money. Anyway, we'll go into more depth with that, but that's just the buying the put options on different strikes, the kind of decision you've got to make as a trader. If you like this kind of stuff, give it a thumbs up. See you next one. Take care, guys. Goodbye.